Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. This is your monthly movers and shakers show where essentially I pick through the big outperformers and the big underperformers over the course of the prior month and try to pick through the bones of exactly what's driving these markets. Will we see a continuation of those recent trends, or has that significant move in one direction set us up for a potential reversal back in the direction it's just come from? We're going to start first and foremost on the indices area. Let me just show you this in greater detail. So you can see here the Swiss 20 up 7% over the course of May, leading the way. Behind that, we had the NASDAQ with an impressive bounce back with a 6.5% rise. Following that, we've also got a big theme around the US, the Russell 2000, the S&P 500. So essentially, it's the Swiss index leading three of the top US indices, notably the Dow Jones lagging behind as we saw its lack of NVIDIA essentially really driving a significant disparity between that market and the likes of the NASDAQ and the S&P 500. The bottom end of things, we've got the Indian Nifty down minus 0.3%. So let's look at the chart and look exactly what's happening with the Swiss 20 and the Nifty in particular. First and foremost, this is the chart for the Swiss 20. Now, what you're looking at here is a area of the market where people have been particularly optimistic because of the relatively low inflation in Switzerland compared to other major nations, the fact that they've already cut interest rates and there's an expectation they will continue to cut interest rates. And so that has provided the basis for a significant upside for this market. You can see here the weakness here in early 2022, giving us this sort of basing pattern. And the gains seen over the course of May really were born out of a rapid ascent at the beginning of the month. In actual fact, pulling back in the last week of the month, essentially, and then surging in towards June. Now, bear in mind, the week just gone has seen the latest GDP number come out stronger than expected. The same went for retail sales. So we did see people calm their expectations somewhat around easing from the SMB. But nonetheless, we're looking at a market that has certainly the basis of a sort of basing pattern here. Low inflation rate does point towards the potential for further easing down the line. And therefore, if you're looking at other markets where there's jitters around inflation, you're likely to see things in a little bit more of a positive light when you're looking at this index. Now, crucially, you can see here this latest rally up during May. We did see that pull back in sort of essentially the final week of the month, a little bit more than that. And so we've rallied up into this prior resistance level, which came in the form of, that is it in percentage terms, 12085. Now, we're currently pulling back from that level, but certainly if we do see a break up through that level, given the shallow retracement, as we can see here, if I was to put a shallow retracement onto here, we're looking at a somewhere between the 23.6 and the 38.2. So we've seen a nice shallow retracement. So if we do see a break up through that 120.85 mark, then there's a good possibility that we see another strong move towards the upside. And that points towards the possibility of an extension and a potentially beneficial risk to reward profile for a bullish continuation. If we stay below this 120.85 mark, and crucially, if we break back below this price swing low that we have here, 11760, then you're looking at a wider retracement to come into play for this wider move here. So you'd then be looking at the possibility of a deeper move into sort of 113s, 115s, that kind of area. But for the time being, knocked on that resistance level, currently pulling back somewhat. But there is a good possibility that this near-term pullback is a short-term phenomenon before we see the bulls try to push us back up through this 120.85 resistance level before long. Then looking at the Nifty. Now, this is a good example of where, if you're taking a specific snapshot of a market or an index, it might not necessarily always give you the greatest idea of what's happening from a wider perspective. Because look, if you're looking just at the last month, you can see here, if we were to get rid of that the market's essentially gone down, it's gone up, it's come back down, and we've ended up marginally in the red. But as you can see here, we've kicked off the new month in style up over 3% in June. And so that has really highlighted why, if we hadn't seen this rally here today, let's say we'd seen another candle down here, I would have been talking to you about the fact that, look, we've got a trend that is very clearly defined towards the upside. We've got the creation of higher highs, higher lows. The pullback that we've seen at the back end of last month looks like a potential opportunity for the bulls once again. And if we don't break below this near-term swing low here, 21821, then essentially this pullback looks like a potential opportunity for the bulls once again. But I don't need to say that because we've already seen that pop into the next move higher, and we've actually seen a push through the top end of this sort of channel here. You can see here that generally the top sort of line up in a parallel line to the bottom end of this, but price has broken up through that level. So that begs the question of, are we now into a more exuberant mode where markets actually have seen an exit from this pace of upside, and we're going to see an even stronger move higher from here? Or are we just getting a little bit carried away with ourselves, and this is just going to be a pop and then fade once again, and we move into another retracement phase? Not sure which one it is, but ultimately the bullish trend does still remain in play. And now that we have broken up through that price swing high, then we can shift up the swing low in question. 22417 is the level that you want to be looking out for now. As long as we remain above that level, the near-term downside would simply be viewed as a short-term phenomenon before we likely see the bulls coming back into play once again. So certainly things have already got a move on here, with the first day of the month seeing a rapid 3% gain for this index, 3.25, which continues the trend. So as you can see here, if we go back to the breakdown, you can see that every market here has gained apart from the Nifty, and that was essentially flat. And now, just a day later, we've seen it gain 3%. So certainly equity markets in a very bullish mode over the course of the past month. Then in terms of the FX markets, as is typically the case, it's either the US dollar is the outperformer or it's the US dollar is the underperformer here, with generally risk attitudes reflecting whether the dollar does well or poorly. Now, with the fact that equity markets have done so well, it's somewhat unsurprising the fact that we've got the US dollar doing poorly over the period, down 1.6%. And on the top end, we can see here the Kiwi dollar, the Aussie dollar, both the big outperformers, as essentially they still have inflation problems, and we're not necessarily expecting much from the central banks over in that area. So whilst you're seeing the likes of the ECB and the Bank of England pointing towards potential rate cuts this year, the same kind of thing with the Federal Reserve, despite the fact that, I don't think they're going to get anywhere near that 2% target this year. Well, over in New Zealand and Australia, things are looking a bit different. There's an expectation in particular over in Australia not so long ago that we're more likely to see a rate hike this year than a rate cut. So certainly a more cautious approach over there. And there's a hope that we're going to also see a boost from an economic standing from China as we move forward, with the Kaishin manufacturing PMI having moved into expansion territory, or moved higher into expansion territory. Gradually, that economic boom that has been forecast for this year hopefully will benefit some of these big exporters as we see commodity prices gaining ground as a result. But let's break down first and foremost the New Zealand dollar, and then we'll look at the US dollar. So back to the chart, and I wanted to bring up this chart first and foremost. Depending on what you're looking at, if this is on your phone, then you might struggle to see the details on this. So let me just zoom in some more. So what we're looking at here is the New Zealand dollar set against a number of the major currencies out there. Kiwi dollar against the US dollar, euro, pound, Japanese yen, Canadian dollar, Swiss franc, Aussie dollar, Chinese yuan. So this is my way of essentially targeting, what's the strong market that, let's say, for example, I think the euro's overvalued or the euro's undervalued. I might struggle to know exactly what I want to pair that trade against. And this is my way of essentially gaining that overview and being able to ascertain what looks like it's shaping up well in terms of from a trading perspective. So if we're looking here in terms of the New Zealand dollar, it has been strengthening. I don't necessarily see right now any justification for a big reversal of that. I'd probably expect to see further strength for the Kiwi dollar. And then thinking about what might weaken. Well, this week we've got the ECB coming out, and if we're looking in terms of price action, this is the weekly time frame. But if we're looking in terms of price action here on the daily time frame, we've got a very clear downtrend over the course of May. If you're looking at the wider chart as well, if I'm zooming out here, you can see, despite the fact that we have got this key support level down below around this 174 kind of area, we can see that we've got these big peaks coming into play, and we've rolled over here, double top formation and heading lower. So for me, that sort of eyeball test makes me want to look in greater detail at this market. So are we topping out here essentially? Because we've seen this big rally over the course of the second half of 2022, the first half of 2023. Then we've moved into consolidation mode. And like I said, we've essentially got, have I got this on deep or shallow? Okay, so we've got these deep retracements here. So first 76.4 fib, the next one 76.4 fib, and now we're heading lower from here. Now bear in mind this is the weekly chart, right? So if we look over the past couple of months, we've got well, we're into the new week, so we've got 1, 2, 3, 4, 5 out of the last 6 weeks have seen significant downside for the euro against the Kiwi. So we've got a big area of support, but we've also got a decent amount of space in before we get into that area of support down below the sort of 174 level. So I think there's the basis for potential continuation trade. You can see that is exactly what's playing out at the moment. But as we see here, we're seeing this nice downward trajectory. It's not necessarily anything too crazy in terms of the steepness. So maybe at some point over the coming day or so, we might rally back up towards this trend line resistance, at which point the bears likely to come back into play. Essentially, for me, this trend looks bearish. We've got this 177.3. If we break up through that level, then, you know, that bearish view of mine doesn't really hold anymore. But the trend over the near term is bearish. The euro is, I think, likely to weaken somewhat, although there are some question marks around whether we're going to see that third rate cut this year, which I don't necessarily think will happen, but it might. So that ECB meeting will see some likely volatility. But I think this is an interesting one to be watching out for. Unless we break that 1773 mark, I think Euro Kiwi looks a notable one. Then I wanted to bring up, where is it? So here is the outlook in terms of the US dollar. So we can see that, just seeing exactly what this is a wider outlook. There we go. So this is the sort of breakdown of the US dollar against a number of different currency pairs. And the dollar has been weakening. So the question mark is, will it continue to weaken? Or are we going to see it strengthen from here? Well, at the moment, I don't necessarily think that we're going to see a big rebound in terms of the US dollar. And certainly, you know, even if that does come into fruition, I think there's a good chance that we need to see exactly that before we actually, you know, start making any decisions, right? So price should lead your sentiment. I think one interesting market to be looking out for here is this dollar Swissy. Of course, like I said, that we've come into this period where we've seen strong retail sales, we've seen strong GDP coming out of the Swiss, and that comes off the back of a period where we saw real ramp up in terms of dollar strength and Swiss weakness. And so the question mark here is, you know, maybe that's got sort of overcooked somewhat. And as we see the dollar coming off, we also see the potential for a little bit of near-term upside for the Swissy if that sort of overwhelming bearishness starts to ease somewhat. So let me just bring up the dollar Swissy chart here. And you can see here that we're now seeing a breakdown through this key support level, which is at 0.898, 898, I believe. And so that to me looks like a little double top formation. Now, back to that wider time frame, and you can see here that the long-term trend is a bearish one. We've seen this big rally over the course of this year, essentially, thus far, and that's taken us back in towards this area of resistance with this 0.924, which was the peak that we had in October 2023. We essentially touched it. We didn't really touch it, but we came up to that level enough for me to think, look, we've rallied up into it. And look how that week ended, right? We ended in the red. So a massive sell-off from that area. And now ultimately we've seen a lower high and a new lower low. So for me, I think this looks pretty bearish. And so it's a question of how this is setting up. We're seeing this sharp move towards the downside. Look out for, you know, potential break from that trend with a rally up through your near-term swing high, which is at 0.90357. But until that break happens, you know, I think this is a really interesting breakdown that we're seeing right now, coming off the back of the latest ISM PMI coming out of the US on Monday, which when I'm recording this. And so I think there's a good chance we could see further downside playing out as we see that little bit of Swissy strength coming into play after a protracted period of the Swissy being very downbeat in nature. Bear in mind, of course, we're talking about the Swiss 20 index earlier. You know, if people start becoming more cautious around the SMB, then you're likely to see that also reflected in terms of sentiment elsewhere for that index. And finally, let me just move on to the next section, and that is commodities. So commodities, we can see here, nat gas doing particularly well, up 28% over the course of the month. Silver really having an incredible time. This is something that really it pays to be able to ascertain what does what and when. You know, certainly at times of strength for precious metals, generally it's silver that does really well, but it can be a bit of a lumpy, bumpy road. Sometimes, you know, you think, well, why is silver not doing that well? Because gold is. And then at other times you'll think gold's doing quite well and silver's having dramatic gains. That's exactly what has been playing out for silver. On the bottom end of things, my head is in the way, but that's why. We've got WTI down 7%. And that's really pertinent coming into this new year, new month, where we have stories around Gaza, we have stories around OPEC. So let's get into it. First and foremost, we've got nat gas. So let's just bring up the natural gas chart, and we can see here from a wider perspective, we've of course seen that massive run up around the inception of the Russia-Ukraine war, the sort of reconfiguration of European supply lines, and a move away from Russian gas, a move towards LNG and imports from the likes of the US and Asia, who essentially just put a premium on that. And so, you know, we saw a massive ramp up, but then we saw the Europeans essentially going hell for leather in terms of driving down their reliability on Russians, but driving up the amount of gas they have in storage. And that essentially warded off any major crises in the winter that followed. But now where are we? Well, we're entering summer, right? So summer is generally the time when we see the use of gas finish, and which is winter, and the sort of refilling, the topping up of the stocks. That is the period that we're in at the moment. Now, bear in mind that we have seen some disruption to flows and storage in Norway, which is why we're seeing some volatility over the very near term. I'm talking about over the recent days. But we have seen a significant run up over the course of this year thus far. But it's taken us into this key resistance level 3119. And now we look like we could possibly be topping out here. Now, in terms of the gains of the month, where you can see here that essentially the gains took place right at the beginning of the month, and the reason why natural gas keeps coming up in this breakdown, you know, I might have to in the future actually start cutting it out, because the reason for it is that, you know, for you to be able to get a 20-something% move when you're up here, you know, you're going to have to move like something like that, right? Whereas if you're down here and you want to get a 27% move, it's more like, well, something like that, right? So it's the devaluation and the deterioration in natural gas prices that has led to oversized percentage moves. But certainly from a wider standpoint, we're still at very low levels, 2.66. You can see previously we were around about 10 at that peak in 2022. So plenty of grounds to make up. I just don't necessarily think that that will happen at the moment. Energy markets have really been hitting the news, and we'll talk about that in the sort of crude oil segment. But like I said, we've got those sort of jitters to kickstart this new month around Norway, but that's already fading. And for me, I think there's a good chance we're likely to see further downside for this market. So yes, we've seen a period of strength, but we've rallied into this big resistance level, and we have been seeing some significant downside since then. The rally here has taken us not through this resistance level 2.852. If we did break through that level, then maybe it looks like we're going to charge back up towards that 3.12 resistance level, but we haven't. We've seen a sell-off since that level. We've rallied, and now we're rolling over once again. It's bearish engulfing candle and a spinning top. And so I think there's a good chance we do see these pressures start to ease further. And part of that is because of what's happening in the oil markets. Now, it was an interesting time at the beginning of trade today on Monday or for this week because we had two major factors playing out in the energy markets. First and foremost, we had the potential and seemingly likely ceasefire that has been crafted by Joe Biden. The rumors have it that despite the potential opposition of some of the members of the coalition in Israel, it seems like Netanyahu might push ahead with it. And there's potential support from those on the Palestinian side. So that points towards potential calming of nerves within the Middle East. Although, bear in mind, the actual implications in terms of supply of oil in the Middle East has been minimal despite this significant incursion into Gaza of late. Well, I say of late, it's been going on for a long period of time, since October. So that potentially being off the board would be a positive and would take some of the heat out of this market. And at the same time, we've seen the OPEC meeting coming into the fore, and OPEC over the weekend essentially saw them extend those production cuts. But crucially, there's a potential for them in October to start allowing people to start increasing production as they move forward, particularly into 2025, where they can increase production even more. So there's a perception that we might see oil flowing more freely as we move forward, increased supply, driving down the price. The easing of Middle East concerns driving down the price. So whilst we've seen weakness in terms of this market over the course of the past month, by and large, that is only born out of the fact that we kicked off the month with a sharp decline, and then we've essentially just seen consolidation. Well, we've kicked off this new month with a sharp decline as well, and so it's a question mark of how long we're going to trade downwards before we consolidate once again. But certainly if we look at sort of the context, you can see, are we going to come into sort of this area here? Are we going to come back down to horizontal support, which would be all the way down at 67.87? Not sure, but ultimately the trend is your friend. So if we see rebounds, then unless we start seeing a rally up through your $81 mark, then rebounds are likely to be short-term in nature. I wouldn't say actually short-term in nature. I would say even if they're relatively protracted, I would say that they're likely to be sold into unless we see a shift in terms of some of these key themes that I was mentioning previously. So likely further volatility, in particular around what's happening with that potential discussion with relation to Israel and Gaza, because that's the kind of thing that could flip on a dime, essentially. But the US are likely to continue to pump heavily. If OPEC are going to start taking their foot off the gas later on in the year, then that provides the basis for exactly what we're seeing now, which is further downside, which is good for markets. Ultimately, weakness in terms of oil and energy prices. In the past, that's been deemed as a risk-off play, so but bad for equities. But it should be good because it drives down inflation metrics, and certainly the lower we see crude go, the lower we see the prices at the pump, the lower the lower the cost for businesses, and so that should be good in the long term.